Live from Bloomberg's world headquarters in New York City, we're tracking the key players, the major moves, and the capital flows shaping global markets. This is Bloomberg Deals.
Welcome to the second ever episode of Bloomberg Deals, the only show dedicated to corporate action reshaping markets. A lot to snack on today. Kraft Heinz halts its plan to split into two, a surprising reversal just weeks after bringing on a new CEO. Plus, Paramount ups the pressure for its hostile bid for Warner Brothers. Paramount sweetens the terms as an activist investor opposes Warner and Netflix's merger. Plus, we're going to bring you our exclusive interview with Bill Ford, chairman and CEO of General Atlantic, a major investor across various companies. He's going to discuss issues including the White House, global diversification, and AI. But first, let's bring you today's big deals and the reporters behind the headlines. First up is Michelle Davis, who's been reporting on the latest fight between Warner Brothers Discovery, Netflix, and Paramount. Michelle, first of all, great scoop on this. You've been reporting about an activist investor coming up and trying to shake things up. What's the latest?
So the news today is that Ancora has built a stake in Warner Brothers. They are agitating against the Netflix deal. Basically, Ancora says, you know, we don't like the Netflix deal. Warner Brothers, we want you to engage with Paramount and try to get a better offer. It's not too surprising Ancora's here. We'd been hearing that there was going to be an activist at some point. The question was who. And now it remains to be seen how much influence Ancora actually has. You know, they've said if Warner Brothers doesn't engage with Paramount, they'll vote against the deal at the time of the shareholder vote in April. And they'll also try to replace Warner Brothers' board. They only have less than 1% stake. So we'll see, you know, how much impact they can have.
So part of what they're trying to do is they're saying push them to get a better deal from Paramount. Paramount did offer a somewhat sweetened deal yesterday already.
So yesterday, Paramount reaffirmed its $30 a share offer, but it did make some concessions that the Warner Brothers board had been asking for. Primarily, it said that it will pay a $2.8 billion breakup fee that Warner Brothers would have been on the hook for if it walked away from the Netflix deal. And it also, in a sign of its optimism about how quickly it can get regulatory approval, it said, hey, Warner Brothers, for every quarter that this deal doesn't close after December 31st, we'll pay shareholders an extra 25 cents a share. So they're clearly confident about their deal. The big question now is, will the Warner Brothers board take them seriously?
Michelle, I can't wait for the next update because I'm sure you're going to have another story about someone else coming in on this space. As always, Michelle Davis, thank you so much. Now, we also learned this week that Duke Energy has signed deals with Microsoft and Compass to power expansive data center complexes as the AI boom supercharges the demand for electricity. I caught up with Duke's CEO yesterday.
Part of the 4.5 gigawatts that we signed up last year as they expand and build, those are all under construction here in North Carolina. It's very good for the communities that they serve. It's very good, like I said earlier, that they're covering their costs and will eventually over time reduce the costs to the rest of the customers. So we're really excited about the opportunities, and we have a lot more in the hopper as well.
Speaking of hyperscalers like Microsoft spending big, Bloomberg's Scarlett Fu is here to break down the record CapEx planned for this year. Scarlett?
Danny, investors call this anything but a typical CapEx cycle. Just look at how the hyperscaler spending on AI infrastructure has shot up over the last few years. If this were a stock price move, analysts would call the trajectory unsustainable. In 2022 and 2023, Microsoft, Meta, Alphabet, Amazon, and Oracle spent a combined $150 billion, give or take a few billion. You fast forward to 2026, and two of the companies, Alphabet, which is the red slice, and Amazon, which is the second tier, purple, each forecast spending more on their own than the total for all five back in 2022. The grand total for this year is around $660 billion. That is more than 4 times what they spent in 2022. So it has become an AI arms race. And even though each of these hyperscalers throw off a ton of cash from their many businesses, the net cash that they generate only goes so far, Danny, which means that they need to seek financing.
A fascinating time in debt capital markets. Scarlett, thank you so much for that. Let's get more on that story. Mandeep Singh from Bloomberg Intelligence is looking at debt deals, and Ryan Gould is reporting on an increased AI investment made by Blackstone. Mandeep, let's start with you because the news of this week had been Alphabet and this huge bond offering they brought. Alphabet has a lot of deals, a lot of money to spend. Why tap the debt markets for it?
Well, I compare them to Apple, what they did probably 10 years back in terms of changing their capital allocation. Back then, Apple went to the debt market to do buybacks, and they ended up issuing more than $100 billion in debt. In this case, Alphabet is saying, we see a lot of opportunity on their cloud side in terms of AI infrastructure build out, and they feel confident about their prospects in terms of the quarter that they just had, 49% growth in their cloud business of a $70 billion run rate, and their core business continues to do very well. So I think it sort of explains why the timing is right for them to do it now, as opposed to,
What about the market reaction? Because the equity market has been upset. Why has the credit market been able to absorb these new issuances so easily?
This is new territory for Alphabet. Like I said, so far, they have been very conservative, with how they have gone about their M&A, their capital investments. But now it feels like this is probably the first tranche of what they plan to do, over the next 4 years. And everyone has been talking about $3 to $4 trillion in spend. So clearly the stakes are high. And as your chart showed, we're talking about 4 times the normal CapEx levels. The good thing is they can normalize. If things don't work out, they can pull back. And a company like Alphabet has, the cash cow businesses to really support this, as well as deal with anything that goes wrong here.
So that's one way to fund your AI business. Another way, Ryan, is something you've been reporting on. A scoop from you that Blackstone is increasing its investment in Anthropic. What was the thinking behind that deal?
Danny, it's an interesting time to be Anthropic. I mean, it's in the headlines for one reason or another. I mean, you could kind of say it's responsible for some of this sell-off in software that we've seen over the past 2 weeks. But I think, just taking a step back and looking at what Blackstone is doing, I mean, Blackstone is putting in another couple $100 million. At today's valuation of Anthropic, $350 billion, that basically takes their combined stake in the company to about $1 billion, which is, not bad for a company, a traditional alternative asset manager like Blackstone, which, puts it up there as being, take out the venture capital firms, take out the sovereign wealth firms. It's one of the biggest backers, traditional backers of Anthropic.
They also back OpenAI too, right? It feels like a different type of investment for a Blackstone who would be known for taking majority stakes for buyouts. How different is this than the usual model for a Blackstone?
It's definitely something to note. I mean, like the last time they invested, which was just less than a year ago, it's actually in September that Blackstone participated in the past round. They're investing primarily out of their BXPE fund, which is the retail-focused sort of business that John Gray is really pushing among, mom-and-pop investors, wealthy ones at that, you can kind of get access and some liquidity among Blackstone's PE strategies. But the other thing I would add is that this is part of a wider trend around double dippers, like we like to say. Double dippers, MGX is also participating. Like Blackstone, they also back OpenAI. So I think that's kind of an interesting question to see, who's going to be the winner and loser.
I love that you caveat mom and pop with being like, but wealthy moms and wealthy pops. An important distinction to make. Ryan, Mandeep, thank you both so much for joining. That's Mandeep Singh from Bloomberg Intelligence and Bloomberg's Ryan Gold. Coming up on the show, we're going to bring you our exclusive conversation with General Atlantic Chairman and CEO Bill Ford. We're going to hear his outlook for M&A in 2026. And would you believe he's very bullish? Stay with us. This is Bloomberg Deals. M&A decision makers have told KPMG that mounting geopolitical pressures and AI disruption are setting up carve-outs to be a major theme in 2026. One firm with massive global exposure is General Atlantic, with a presence in 20 countries and $123 billion in assets under management. I spoke exclusively with General Atlantic Chairman and CEO Bill Ford about how he views the big picture and his company's international footprint.
I think, if anything, it's made us, the current environment with geopolitical volatility, macroeconomic volatility has made us more committed to global diversification. And, we've been investing globally for over 25 years. And we've, businesses in Europe, India, China, Southeast Asia, Latin America. We've got investment teams on the ground. And it's been about 50% of our investing activity has been outside the U.S., really for the last 15, 20 years.
And so that ratio, it hasn't changed at all. You're just keeping it and you're committed to it then?
Yeah, I mean, our investment strategy is bottoms up. We try to find investment opportunities all over the world, but we have a lot of conviction that global diversification is good for our clients in terms of managing risk, but also finding opportunities. And we find great entrepreneurial companies all over the world. I mean, last year, I just mentioned two of our most exciting investments. One was a female-founded beauty company in Dubai, but 95% of the revenue being outside of the Middle East. East, and it was the leading fragrance brand at Sephora last year. So, only by having investment teams on the ground in the Middle East are you going to find an opportunity like that. And we talked a bit about Japan, and same thing there, an investment team on the ground finding a great new software company in Japan.
How are you feeling about China at the moment? Because it's an area where you have historically been active. There was a moment where General Atlantic pulled back a bit. Are you now fully back in the country? Do things seem settled enough geopolitically that it's once again an attractive geography for you?
I mean, we've actually sustained our commitment to China over the last 25 years. We actually started our office and opened our business in China in 2001 and been investing there for quite a while. And I would just say that China, as the second largest economy in the world, as a center for innovation in lots of areas like green technology, is only gaining pace and creating significant opportunities. It is more complex to invest in China, given the geopolitical issues between the U.S. and China. But I think investors are really going to be missing out if they're not active in China going forward.
How do you then decide that when there's headline volatility of latest trade missives or concerns around what the president is going to say about involvement? How do you decide what's noise and what actually impacts your investment outlook?
Well, you've got to combine the micro and the macro. We start from a micro view, the attractiveness of the company, its market position, the size of its market opportunity. We start there, the quality of the entrepreneur, and that's what really drives our investment program. But we've got to put it in a macro context, and the macro context for China right now is more complex than it was, let's say, in 2008 at the peak of sort of U.S.-China relations.
So what does it mean when it's more complex? How does that change how you operate?
Well, there's more restrictions on what we can invest in and can invest in. I mean, if you go back again to the 2000s, the market was pretty wide open in terms of backing entrepreneurial growth companies in the private sector. Today, there's just more restrictions. Technology crosses over to national security concerns for both countries, and we've got to take that into account.
And this is an administration in the United States that has been very keyed in on this. And you're no stranger to this, having TikTok being in your portfolio of companies that have had to deal with this administration being involved in deals. How do you view that, the White House taking a more active approach among corporate America?
Well, my fundamental view about the Trump administration is that they're pro-business, pro-market, and that's been positive. It's been positive for business, and they've encouraged commerce globally. They've encouraged investment globally. They clearly want more investment in America, and that's a good thing. But they've been incredibly supportive, and I think they were quite constructive on TikTok. They recognize that there's 200 million monthly users in America, customers that love TikTok, and they wanted to find a way to safely make it available for Americans, and they found a good solution.
Does it change at all how you invest in terms of maybe things like national security, being more interested, those kinds of themes than they once were?
Well, I think there is a convergence of technology and national security that one creates significant investment opportunities on one hand, and we've got to take into account. But we are in a world where geopolitical risk is elevated. And I think back over my career, a 30-year plus career of investing, and it used to be you were more concerned about macro issues. What's the GDP growth rate going to be? Is there going to be inflation? What are interest rates as the primary driver of the macro context? Now it's geopolitical risk. Now it's like, what's going on with U.S.-China? What other flashpoints might exist that could be a significant, risk for a new investment?
Well, that's the thing, because this is supposed to be the year of M&A, the year where everything comes back. Do you think geopolitics slows that down a bit, or have businesses just learned to cope with it?
I think business leaders have done a better job understanding and navigating the external environment. And I do think M&A is going to come back in a significant way this year. One thing we've thought a lot about is that we had an exit recession for the private equity industry, during the 21 to 24 period. It was a very, very tough time. Unconventional antitrust policy. I think heavy regulation coming out of the SEC. The Trump administration has given us a much more pro-business, as I said, pro-market environment where I think companies are thinking strategically, are thinking, what is the M&A move that I need to make that really strengthens my competitive position? And so I think we're going to have an active period.
How active? Can we ever, for example, rival the years of 2021 and 2022?
I think from an M&A point of view, it's going to be the most active M&A market we've seen in a decade. And I think a lot of companies are saying to themselves, we've got a good economy, rates are turning down, flat to down. This is a very good environment for us to really, think strategically and think about consolidation in their markets. So I think what I see below the waterline right now is a lot of dialogue among executives about trying to get things done. I think that will materialize into M&A deals over the course of the year.
And I know you spend a lot of your time talking with entrepreneurs. What are you hearing from them? What is the angst, and what sort of advice are you giving them right now?
Well, I think it's hard being an entrepreneurial CEO because you've got to navigate the external environment while still running your company day to day and navigating rapid growth. So what I've really tried to communicate to them is say, look, invest in your team, build a great team so you've got more capacity to manage the external environment. And we try to be a great partner. We're an active investor. We work in partnership with our entrepreneurs. We try to be a resource to them to help them navigate a more complicated environment and think about M&A creatively.
How are the entrepreneurs of software companies feeling at the moment, Bill?
Well, it's been an interesting week.
That it has.
But the way I look at it, I still believe most of these software business models are quite durable. And I think when you have applications that are integrated into business processes with data embedded, I think they're going to be remain critical. And I think AI is a potential enhancement actually versus a risk. So, excuse me, I'm less concerned about the displacement of these companies. But what has changed is valuation.
Yeah.
10 years ago, software companies were valued at about 4 times revenue, and they went all the way up to 10 to 12 times revenue at the peak in 2021, even into this period. And I think they've come back down to where they were, about 4 times revenue. So valuation has changed. I'm not sure the business models have changed that much.
What's allowed us to reconsider and rethought the prices we should be willing to pay for these companies?
Well, I think that there was. I think there's some questions about what is the growth rate going to be for this industry with AI, and will AI siphon off some of the future growth, or will it enhance the existing competitors? I think it's going to be a little bit of both. I think you're going to have some new AI-driven application companies that are going to take some market share and actually represent some very exciting investment opportunities. But then you're also going to have some, I think, existing companies that will harness AI and create a new wave of growth. So I think it's a little bit of both. But I think the market is saying, until I understand more about what AI is going to mean and what it means for growth rate, I'm going to take a more cautious view on valuation.
What about the other side of the coin, which is the huge amount of spending that AI companies are doing? You and your team at GA obviously are experts at analyzing businesses, and tech businesses specifically. It's a sector that used to be loved because cash flows came in, margins were really good. Yeah. Is it concerning, or how do you view a tech sector now that's increasingly having to spend more money and also spending it on things like infrastructure and heavy assets?
Well, it's a significant change, but if I just step back for a minute, this is the fifth major tech cycle that I've been involved with. I think back to the PC cycle of the 80s, the internet cycle of the 90s, the mobile cycle of the 2000s, cloud in 2010s, and all of these cycles. You created very large new markets, introduced new business models, great new competitors, and they didn't just change the tech sector, they changed business and society in some fundamental ways. And I think AI is the next great wave of that kind. It might even be a super cycle that builds on 40 or 50 years of development in the tech sector. So it's huge. But I think there's real information in the level of spending from the tech giants that I think hasn't been talked about enough, which is I think they see what we see. There's tremendous demand. Going to be tremendous demand for AI, almost infinite demand. It's going to feel like infinite demand for the next 4 or 5 years. To me, the working definition of AI is it's intelligence on demand. And I think with the tech giants see is that there's going to be so many applications, so many ways for people to use intelligence on demand that they're making a very strong bet. They have tremendous conviction. Demand is going to be there. So the challenge is, can we supply it? And I think they're voting with their wallet. They're saying, like, look, we're so convinced of the demand side. We're going to move from an asset light, cash flowing business model to really put all our chips on the table and invest in the future. And I actually think it's a good bet because, again, the demand side is so strong.
So those bubble fears clearly aren't there for you.
Not for me. Look, there's questions. What's pricing like? What's business model? What's return on capital? I think those are all legitimate questions that will be answered, will have to be asked and will be answered in the future. But if I'm running one of those tech giants, to miss a leadership position in producing intelligence on demand for the future, which will reshape the entire tech industry, and will, as I said, I think will reshape business and society, you can't miss it.
Thanks again to General Atlantic Chairman and CEO Bill Ford, and you can watch the full interview online and on the Bloomberg terminal. Coming up, we're going to get a check on markets as traders digest the upside surprise in today's jobs report. Stay with us. You're watching Bloomberg Deals.
Melinda, let's take a look at your midday movers. First up, U.S. payrolls topped estimates, adding more jobs in January than it has in over a year, while the unemployment rate decreased unexpectedly. That's a sign that the labor market may be starting 2026 on solid footing. Meanwhile, shares of Micron climbing after the CFO told Wolfe Research Conference that supply is likely to remain tight beyond 2026 and gave an update on production of the company's latest high bandwidth memory, also known as HBM4. And finally, Robinhood shares are tumbling after the online brokerage reported lower fourth quarter profit with declines in Bitcoin and other cryptocurrencies at the end of 2025 weighing on results. Those are your midday movers. I'm Nora Melinda.
Nora, thank you very much. And you are watching Bloomberg Deals. I'm Danny Berger alongside Scarlett Fu. It is time now for Give Me Some Credit, a look at prominent credit stories. And it feels like a lot of the stories right now are about struggling retailers, Scarlett.
It's in the consumer space, so I've got two for you. Let's start with QVC, the TV shopping network. In talks with creditors over a voluntary credit restructuring, QVC had about $6.6 billion of outstanding group debt as of September 30th. It's also drawn almost $3 billion from a credit facility that comes due in October. There's some tax liability issues. The other thing is this shopping network sources a lot of its goods from China. And you know, with the tariff situation, it needs to mitigate the impact of that. So that's an operational challenge it has to deal with.
Some of these, though, I feel like have really strong brand names like Saks or even Eddie Bauer. I know that's one you're looking at, that even that brand name isn't helping them escape a bankruptcy fate.
No, in fact, it's filed for bankruptcy for a third time in its lifetime. The previous filings were in 2003 and 2009. According to court papers, it's got $1.7 trillion in debt and less than $500 million of assets. We know that Eddie Bauer has already agreed with secured creditors to auction off its brick and mortar operation. So really it's about the brand and what happens next to that brand.
I mean, it's just the era of easy money is over, right? Like you can't keep piling on debt piles and have that carry you through to growth.
Absolutely. And consumer tastes have changed.
It's true. And I know Saks is another one that's going bankrupt too. Another good brand?
Another good brand. Well, depending on who you are. Maybe not so good for some others.
Yeah, fair enough. Hey, Scarlett, thank you so much. Those are the latest credit stories, the bankruptcies in the retail space. In our investor committee coming up after the break, we're going to take a closer look at the consumer sector, as is Scarlett, after Kraft Heinz halted its plan to split into two. That's coming up next on Bloomberg Deals.
Live from Bloomberg's world headquarters in New York City, we're tracking the key players, the major moves, and the capital flows shaping global markets. This is Bloomberg Deals.
Welcome back to Bloomberg Deals. I'm Danny Berger. Kraft Heinz reported earnings this morning where it announced it has halted its plan to split into two. It's a surprising reversal that comes just weeks after bringing in a new CEO. Scarlett has more on the move. Scar?
Well, in today's announcement, Danny, new CEO Steve Cahillane explains that since joining Kraft Heinz, he's seen the opportunity is larger than expected and that many challenges are fixable and within its control. So instead of pursuing a separation, the company will now invest $600 million in marketing, R&D, improving its products, and reducing some prices. Now, the planned breakup, that was aimed at ending a sales slump that has now dragged on for 9 quarters. And the thinking was a spinoff of the slower-growing but cash-generating grocery business would give the faster-growing condiments and boxed meals business more room to run. Cahillane had been CEO of Kellanova, which itself was spun off from Kellogg and later taken private. Now, another twist to consider here is that top Kraft Heinz shareholder Warren Buffett is skeptical that a breakup would fix Kraft Heinz's problems. Buffett's Berkshire Hathaway has since indicated that it wants to sell its 28% stake. So, Danny, maybe the new CEO is kind of listening to Buffett?
I do think people tend to listen to Warren Buffett, so that's not out of the question. Scarlett, thank you so much for that. And that brings us to this week's Investor Committee, where we debate where you should be deploying capital. And today, speaking of consumer, we're going to be talking about just that, consumer and retail. Let's welcome our IC members today. It is Emily Miller. She's Bain & Co.'s U.S. Consumer and Retail Investing Vertical Co-Head. Eva Davis from Winston Strawn. She's Managing Partner and advises PE on consumer brands, and Joshua Benn, Global Head of Consumer Retail and Restaurant Investment Banking at Kroll. And what an interesting time to be thinking about consumer deals. Eva, let me start with you. What is your #1 investment idea for the consumer sector?
Yeah, I mean, anything around protein. It's sort of the word of the day, the month, the year. So anything in food, and it's even expanded into beverage and beyond.
Emily, Eva says food, beverage, all about protein. What do you think? Do you agree, or is there something else more attractive?
I think protein is an excellent way to play trends within consumer products, but we like consumer products and consumables more broadly than that as well. We love the idea of backing strong insurgents. We think that opportunity for private equity in those insurgent brands will continue despite activity from strategics. And we think that opportunity to back big scale carve-outs will continue. We're seeing that the large CPGs are continuing to rethink their portfolios, and that's going to create opportunities for private equity.
Yeah, certainly seen a lot of carve-outs, and even the Kraft Heinz companies coming apart. Josh, how about you? I know you've worked with a lot of supermarkets. You've also worked with restaurants. Where in this sector do you think is most ripe for deals? Where are the big targets?
Well, we're seeing a lot of activity in the food and beverage space generally, beyond just protein, in the perishable categories, bakery products, ingredient products, within restaurants, asset light, limited service businesses continue to attract a lot of attention in the market. Consumer services broadly, franchisors. We're seeing a lot of deal activity in those categories as well. So the market has certainly picked up as we've moved into 2026. There seems to be a good amount of activity across a number of categories in consumer that weren't seeing a whole lot of activity in the past few years.
Josh, if I can just stick with you for a moment, because Emily mentioned that a lot of this is going to come from private equity. Where do you think? Who are the buyers for this? Who's going to be? Is it going to be mostly corporates doing these deals, or is private equity coming in force?
We're seeing, a good mix of both private equity, actually family offices, as well as strategic buyers. We closed a transaction earlier in January for a French fry manufacturing business, processing business that was sold to McCain Foods. So we had a very active private equity centric process that was going on, and McCain showed up and paid a market clearing price for the business, and it was a great transaction outcome. So it's a good mix. There's certainly a lot of private equity capital that is looking to be deployed, but we've also seen a good level of activity from the strategic.
Eva, same with you, especially if you're thinking about things like protein, food, packaged food. Is this a deal you'd recommend to your private equity clients or to your corporate ones?
I mean, what we're seeing is we're seeing a lot of this growth in private equity and family office for sure. I'm seeing them be a little bit more of the first movers that are the ones, recently when L Catterton just closed on their deal with Good Culture last week, and it had been backed by Manitree and Seminole Foods Capital. I'm seeing private equity kind of be the first movers, whether it's protein or going back to other types of functional foods and wellness and longevity products. They're kind of pushing it and scaling those businesses and then hoping to sell to the Mondele's, Hershey, Pepsi's of the world. So look, certainly the strategics will be there, but I think finding those innovative emerging brands, I think PE's been showing that it can be very successful at that.
Well, as with every investment committee, we need to talk about the risks to all of yours investment theses. Eva, how are you thinking about the macro risk, the concern, especially after yesterday's retail sales, that maybe this is a consumer that's pulling back? How does that shape or even challenge what you're proposing?
So I feel like there's two sides to this coin. There's continued concern, as there has been in the last couple of years, over inflation, commodity cost swings, packaging cost pressure, rising costs of ingredients, and of course the horrible word tariffs. And deal lawyers have become very good at tariff earnouts if they want to get their deal closed. But the sort of flip side of that coin is, and I'll head back to protein, it's those GLP-1 users. We now have a quarter of U.S. households have at least one person in their family using GLP-1s. And interestingly, I think the early nervousness was they're cutting back on food purchases. They may not be purchasing the same volume of food, but they have definitely upgraded in terms of their tastes and their meals and what they want. And so there's some opportunities there to be disruptors in terms of how kind of almost the new consumer is thinking about what they're putting in their basket.
That's interesting. GLP-1 an opportunity, not a threat. Emily, would you agree with that?
It depends on where you play and what your business is, but absolutely there's opportunities to take advantage of GLP-1s. We do proprietary research on this, and while there's been reports that a quarter of households have somebody on GLPs, it's only about 7% of U.S. adults today. So it's still relatively limited, though growing really fast, and frankly faster than many people expected. We expect penetration to double, so almost 15% of U.S. consumers on GLP-1s by 2030. And when we look at their spend, you're absolutely right, it is having an impact. Overall grocery spend is down about 4% for active users of GLP-1s relative to non-users. But that impact is much bigger in categories like salty snacks, sweet, sugary sodas, whereas spend actually goes up in the perimeter of the store. Fresh produce, fresh poultry, those are categories that are benefiting. Regardless of where you are within food, if you can adapt your offering, smaller portions, denser nutrients, that's going to be a winning play with GLP-1 consumers.
Well, also, Emily, if you're looking at a little bit of the sector in more of a broad sense and perhaps less targeted, how are you thinking about the risk of a consumer slowdown?
Well, one of the big risks for all consumer investors right now is that they have a backlog of assets on their books that they need to exit. And one of the reasons that exits have been challenging over the last couple of years is because consumer spending has been so volatile and so choppy. Businesses really need to string together a couple of quarters of strong EBITDA performance in order to sell their business. And right now, we still see this backlog of businesses with choppy EBITDA. And so if consumer spending or any other macro shock disrupts that string of stronger performance, it's going to make it harder to exit.
Josh?
Now, of course,
Emily, if I could just jump in,
IPO market, Bob, Once Upon a Farm, that's a good sign.
That's true. We did get a lot of consumer IPOs, and the exits are happening. Josh, I just wanted to bring you into this too. Do you agree with Emily, this idea that they need to prove some growth and any slowdown could be an issue?
Yeah, 100%. I mean, performance during a transaction process, leading up to and during the transaction process is critical. And that volatility always makes it difficult. Uncertainty is the enemy of all transactions. So, irregardless of what that uncertainty is driven by or that volatility is driven by, it does make it more difficult for transactions to get completed. We have seen a lot of structural solutions coming into the market where people are able to solve for some of that volatility. But it's a critical component to any successful transaction.
I've got literally 20 seconds left, so I just want to quickly, each of you, get your take. How big of volumes are we going to see for the consumer segment this year? Is it going to be more? Is it going to be records? Is it going to be slow moving? Eva, let me start with you just in a few words.
I think we're going to see much more this year, mainly, again, led by private equity and family office, with strategics to follow probably in the following year.
Emily?
Last year wasn't a bad year, actually, when we look at the numbers. It was the third highest in the last 10, but I think this year could be stronger.
And Josh, take us out.
I agree that 26 will be stronger. I think the middle market was actually challenged the last few years, and we're starting to see a lot more middle market transaction closings. It's important to look at deal volume versus number of transactions, or values versus volume.
All right, thank you all so much to today's investment committee, Emily Miller from Benn, Eva Davis from Winston Strawn, and Joshua Benn at Kroll. We thank you all for your time this morning. Up next, we're going to talk about how AI might not be the death of software stocks. We're going to speak with Holden Spaht, Managing Partner at Thoma Bravo. That's after this commercial break on Bloomberg Deals.
We're just about halfway through the trading day in New York. I'm Nora Melinda. Let's take a look at your midday movers. First up, shares of the London Stock Exchange are bouncing between small gains and losses after activist hedge fund Elliott Investment built out a stake. This comes as the FTSE 100 index owner grapples with disruption from artificial intelligence and the plunge in listings. Elliott is encouraging the London Stock Exchange to launch a multi-billion pound share buyback and close the margin gap with rivals, though the activist investor is not pushing for a full sale or a spin-off of its stock exchange business. Also, T-Mobile shares jumped to their highest since December after the telecommunications firm raised its outlook for service revenue to as much as $81.5 billion in 2027. Still, the company added fewer mobile phone subscribers than analysts expected in the fourth quarter, highlighting the challenge ahead for the new CEO. And lastly, Shopify's fourth quarter results beat expectations after strong holiday spending lifted revenues. The company's revenue grew 31% to $3.7 billion during that quarter. That topped the nearly $3.6 billion estimate by analysts. Still, its stock plunged after its adjusted earnings fell short of forecasts. Those are your midday movers. I'm Nora Melinda.
Nora, thank you so much. You're watching Bloomberg Deals. I'm Danny Berger. And we've been seeing stocks getting pummeled as people are assuming that software will be consumed by AI. But a longtime software investor tells me that's not the story. That brings us to this week's Premium Players, where we spotlight insiders close to the action. Today, I spoke with Holden Spaht, managing partner and top deal maker at Thoma Bravo. He pushed back on the narrative that AI spells doom for software companies.
We see so much opportunity in this new world of AI. We don't necessarily view SaaS and AI as different things. All of our software companies are using AI, they're selling AI, they're developing AI. And so we think the public markets, particularly for companies that have a certain set of attributes, and I can describe those attributes, but are not being very discerning. In other words, to think that all software is the same, we think is they're missing the mark a bit. And so we love the way values are trending, especially in our space. And when we compare that to the performance of our companies, which is very strong, we think this could be a really exceptional buying opportunity.
I'm wondering where you're finding the value now. Is it in the public companies that have sold off, or in private markets? Are you seeing a lot of funds trying to unwind some of their software exposure that you'd be interested in picking up?
We're seeing both. And I mean, the public is obviously the first place to look. It reacts the quickest. It usually takes private valuations a bit longer to adjust, but there are people that are very risk off and they're trying to diversify out of software. And so those are opportunities, but also the public stocks, again, for the right types. One of the real benefits of being a sector specialist is we feel like we have a really good sense of what's working in this new world of AI, and we see it in our portfolio. And so we feel like we can discern what we should be buying and what we shouldn't be buying. So there's a lot of opportunity in the public markets as well.
There must be some threat somewhere, and I know you've written a bit about this. You wrote in the FT this idea that it's not going to be these AI startups that necessarily come and disrupt things, but it's going to come from the big foundational models, the OpenAI, the Anthropic. What are they able to disrupt?
Yeah, it's a great question. Look, these model companies are incredible at data science. They are not as great at understanding specific business processes in a large enterprise. And so we think, again, this combination of domain knowledge and AI, ultimately the winners. I described a set of characteristics earlier that we think really lends itself well in this new world of AI. So if you're going to say, what could they disrupt? Probably the opposite of those characteristics, which is, you know, maybe I'm sorting leads. It's a tool to sort leads for an inside sales rep, or it's a front-end marketing automation tool, or it's choosing words out of a document management. So there's several categories where they are probably less resilient, but on average, for the types of companies that we own, we see a lot more opportunity than risk.
Are there any more maybe legacy software that you have bought, that you bought with not fully foreseeing what's happening with AI, and you need to change and you need to adjust? Have there been any disruptions in your portfolio companies, and how are you dealing with that if so?
You know, we haven't seen that yet. To be honest, like I said, I'm on 10 boards, and they all just had exceptional Q4s, and they all exceeded their forecast. I'd be dishonest to sit here and say that every company we have indexes as well as, but 95% of our companies do index really well in this world of AI, because we start with quality of revenue, right? When you buy a company that's got 97% renewal rates, high customer satisfaction, it tells you a lot about the company. It's a deeply embedded business process. It knows its domain very well. It's accumulated over, in the case of Jeppesen, over 100 years of helping airlines fly planes. I mean, there's a lot of accumulated domain knowledge, bug fixes, all these things. And so on average, we're seeing a lot more opportunity, and it's actually showing up in our results. We're selling AI, we're growing faster, we're accelerating. So in general, when you start with that quality of revenue, I think it indexes pretty well in this new world.
I hate every question that I'm asking is a downer, so stick with me here because it just feels that there's just a lot of skepticism. And I know one of them that you've addressed head on, specifically on LinkedIn, is this idea that maybe companies are still going to have enterprise software, but they're just going to be spending less on it because they're spending more and more budgets are going towards AI. What do you think of that narrative?
Yeah, look, these are all legitimate debates to have. I sit on all these boards in our companies too. I mean, our CEOs are saying AI, AI, AI. Again, that's why I don't think there's this clear line between AI and software. AI is software. Software is AI if you do it right. And so, again, I would just go point to our recent results, right? I sat in 5 board meetings 2 weeks ago after big ends of the year, and the median bookings growth rate year over year, net new ARR added was 22%, which is higher than the median revenue growth, which means those companies are accelerating. And AI is a part of the story. Like they're selling 10 to 15% of the SKUs on average, probably in Q4, were AI SKUs. And companies are going on this journey with us because we have the domain and we understand how their data works.
What do you make of just this like spat of announcements of companies as quickly as they can, it feels like, trying to put out AI products that can theoretically replace something?
Totally. Look, we're not immune to reading the headlines and saying, gosh, what's happening, right? And so there is this. And so that's why we always go back. And we just had our inaugural, despite how many years we've been doing this, our inaugural CEO summit. We had all our CEOs in Puerto Rico last week. And we went through it. And of course, we all play with these tools over the weekends and say, and I think we keep coming back to the marriage of domain knowledge, understanding an enterprise business process for these companies that are 96, 97% renewal rate, where calculations have to be correct. That's just a really defensible moat. I don't even want to call it a moat because we're growing faster. We think there's a huge TAM expansion opportunity. Now, we can't be complacent. We have to be developing new AI SKUs. We're taking big customers along. In Anaplan's case, like here's what the agentic office of the CFO is going to look like in 3 years. And we think, frankly, tools like Claude, which we're using in all of our companies, they're like, we are a great route to market for them because they don't understand these domains in the same way that we do, these enterprise business processes in the same way that we do. So we view them, we love these tools. We're AI first, but we view them as our company is a great route to market for them.
Are you about to get a call from Sam Altman? Do you only use Claude and none of the other models?
No, we actually internally we use ChatGPT.
Okay, he'll be happy to know that, I'm sure.
But Anthropic's making really good inroads in the enterprise, and our companies do love the tool. So
what about Gemini? Is that factoring in?
Gemini, I mean we play with them all.
Thanks again to Thoma Bravo's Holden Spaht. Coming up, getting back to consumer-focused companies as corporates make stock market debuts this year, including Jennifer Gardner's Once Upon a Farm. That's next. This is Bloomberg Deals. To close this week's show, we're looking at consumer IPOs with Bloomberg's Bailey Lipschultz. Bailey, it does feel like we've gotten a lot recently.
We've gotten a lot. We've gotten 2 in 1 week. Bob's Discount and Jennifer Gardner's Once Upon a Farm, the first time that's happened since 2021. So activity showing signs through.
And it also comes as cyclical companies are back in fashion.
Yeah, investors are looking to diversify. So we've seen actually an outperformance for those stocks, both up double digits, which stands kind of against a backdrop where crypto and other kind of tech-enabled industries are down double digits.
But it's also against the backdrop of poor retail sales, concern about the consumer. Why are they so confident that they can IPO?
They're at least getting deals out the door. Bob's priced at the bottom of a range. Once Upon a Farm does have the Jennifer Garner effect. So you are seeing kind of those green shoots showing through, or at least companies wanting to get out the door.
And of course, once you look beyond the consumer space, you've got some big tech names coming up.
We've got the big tech names. We've got everyone excited about SpaceX. Also in industrials, Madison Air is a huge company owned by private equity, as well as Blackstone's Copeland. So diversification.
A busy year. Dare I say the year of the IPO, Bailey?
I've heard that from a few people.
Yep, fair enough. One John Gray, I believe, said that. Bailey, thank you so much for your excellent reporting. And that does it for Scarlett and me on Bloomberg Deals. And stay up to speed even after the show. Subscribe to the Bloomberg Deals newsletter. Up next, it's Balance of Power, live from Washington. This has been Bloomberg Deals.